Looking at a blank stock chart and guessing which way the price will go is like placing a bet at a casino. You are relying on luck, and the house almost always wins. You can replace that guesswork with math. We are going to build a concrete three-part system: trend, location, and confirmation. We turn a blank screen into a structured setup with a clear floor, entry trigger, and defined risk limit. To execute, you need two tools: a free charting platform like TradingView to analyze data, and an active brokerage account to place the trade. Locking in this workflow provides a defense against market noise. It replaces the hope for a lucky break with a repeatable, calculated formula. This jagged line chart only shows you the closing price, which hides the actual battle between buyers and sellers. We need to discard this and switch to Japanese candlesticks. A single candle gives us 4 exact data points: the open, high, low, and close. But a candle is useless if you are looking at the wrong time scale. If you are holding the trade for a few days, a swing trade, set your chart to a 1-day time frame. If you are buying and selling on the same day, you compress that data and switch to a 5-minute time frame. Now we find the overall momentum using the 50-day moving average. This line calculates the average closing price over the last 50 periods and plots a smooth curve right across your screen. This line creates an absolute rule. If the price is sitting below this curve, the sellers are in control, and we do not buy. We only hunt for buying opportunities when the price is clearly riding above the moving average. Aligning your time frame with the 50-period average filters out the noise of minor price swings. You are positioned with the momentum of the established trend. Step 2 is finding our location. We are looking for support. This is a historical floor on the chart where the price previously dropped, but buyer demand was strong enough to force the price back up. Many beginners draw a single thin horizontal line to mark this floor, but markets are volatile and a thin line snaps easily. It leads to false breakouts that trick you into thinking the floor has broken. Instead of a thin line, use your rectangle tool to draw a thick shaded zone. A zone acts like a sponge. It absorbs normal market volatility and accurately catches the falling price before bouncing it back upward. The exact opposite is true at the top of the chart. We map out resistance by drawing another thick zone, where the price has repeatedly hit a ceiling and deflected back downward because sellers took control. By defining these two boundaries, you trap the price in a specific arena. You are waiting to engage only when the price enters a mathematically advantageous location. Now that the price has dropped into our support zone, we do not buy blindly. We need precise physical proof on the chart that the buyers are actually stepping in. In this diagram, we are looking for a specific shape, the hammer candle. The price drops deep into the support zone, but then a long lower wick forms. That wick is proof that buyers aggressively rejected the lower prices and pushed the market back up. But a hammer candle by itself can be a trap. The market often creates fake reversals where the price looks like it's bouncing, but there simply aren't enough actual traders participating to sustain the move. To validate the signal, we check the bottom of the screen for volume. Volume measures the actual number of shares changing hands. If the hammer candle forms while that vertical volume bar spikes, we have the fuel required to trust the signal. We have our location at the support zone, our signal from the hammer candle, and our fuel from the volume spike. Layering these 3 elements increases the statistical probability of the trade. Even a valid setup is useless without defining the exact mathematical risk to reward parameters. We have to map out our entry, exit, and risk thresholds before committing any capital. Using our positioning tool, we lock our exact entry point right at the top of the hammer candle's body, where the candle closed. Next, we map our danger threshold. We draw a red boundary box down to a point just below the absolute lowest tip of the hammer's wick. This is our stop loss. We give the market a little room to breathe, but if the price drops below this line, we exit immediately. Finally, we extend a green boundary box upward from our entry point, stretching it all the way to the resistance ceiling we mapped out earlier. This is our specific profit target. By comparing the size of the danger threshold against the profit threshold, you can see if the potential reward is worth the risk. A solid setup should offer significantly more gain than potential loss. Plotting these numbers onto the chart provides an objective framework for the trade. You have established exactly what you stand to make and exactly what you are willing to lose before the price starts moving. The final mechanical step is execution. You take the exact price coordinates for your entry, your target, and your stop loss, and you transfer them directly into your live brokerage order ticket. Taking a loss is never easy, but reframing it is necessary. In this business, a stop loss is a mandatory expense. That locked door protects your core capital from catastrophic damage. Check the 50-day moving average trend. Map your fixed support zones. Wait for hammer and volume confirmation, and strictly apply the stop loss. It is time to put the work in. Log into your charting software right now. Pull up a live stock chart and draw this exact framework over one stock to cement the methodology.